two of your previous guests in the last 30 minutes talked about or basically said that maybe the yield curve isn't quite as important as it has been in the past. And I would tend to somewhat agree with them. You know, as one of your guests pointed out a couple months ago, the yield curve inverted. And, you know, historically, 80% of the time, an inverted yield curve means a recession's coming in 6 months to 2 years. And they gave different reasons for why they thought that this time is different. And it's always kind of a scary thing to say this time is different. But I'm going to say it, too. This is why I think this time is different. We've had, with all the global quantitative easing, including obviously in the U.S., that's manipulated the yield curve in ways that we haven't seen historically. And I just think, you know, earnings continue to be strong. GDP continues to be strong. We're going to get a revision on that today. Obviously, the trade war has kind of been a negative for equity markets recently. But if we get that resolved, you know, I basically think with the trade war, all the negative stuff is already baked into the market. So if we can get that resolved, at least and at least kicking the can down the road, then that would be a boost for equity
that's a
markets.
big statement, Rob. I mean, you're saying that there can be nothing that happens on the trade front negatively that could take down the markets further from here. I mean, tell us why.
Well, you know, when you look, and obviously trade is a big issue, but it's one big mathematical equation. I mean, we've got domestic production and demand, which really in a big way dwarfs you know, the trade situation. So when you look at it that way, I mean, it would just take a heck of a lot on the trade front in a negative way to drag us into recession, and so I'm kind of agreeing with your previous guests that they don't see it coming, and quite frankly, at least in the near term, every business cycle ends. We will eventually get a recession. I just don't see it really in the next 12 months or so. All
right, Rob. One of the places that we have seen a little bit more of the downturn is in small cap stocks. They were supposed to be more immune to issues with trade. Is it still the situation that if you fear trade, you should be in small to mid-cap U.S.-based equities?
I think so. As you correctly pointed out, it's been a sector that has struggled a little bit lately. But yes, I mean, trade issues are going to negatively affect big cap multinationals more. And even though not all small cap companies are just domestic, a higher percentage are. So that would suggest that you take a little bit out of the large cap multinationals, put them into small caps, and so yeah, I would definitely overweight the small caps at present, small cap growth stocks presently.
All right, just a couple seconds here. Any parts of the market you like?
Yeah, I think, you know, as far as the S&P 500 sectors, my favorites right now are staples, financials, utilities. They seem to all have good valuations. They've got good visible earnings growth and good relative strength.